presentation is about your case study, which will be the creation of a risk-return analysis of an investment portfolio. So the case study consists in create a portfolio, establishing the portfolio objectives. Okay, you are going to create and formulate an investment strategy. And we are going to describe in your portfolio what is your investment policy statement, which will represent the deals and decisions that you're going to create in your portfolio as a long-term investment. Okay? You are going to describe and select the categories of assets and how much allocation you are going to provide to each asset. The investment policy is an official statement of any portfolio or mutual fund that provides the goals and objectives of your portfolio in terms of returns, risk tolerance, liquidity, any strategies you're going to develop in your portfolio. An investment policy investment respect the return and risk tolerance of your portfolio, the time horizon you want to run this portfolio, okay, the liquidity needs, which means if your portfolio requires certain level of dividends and interest at a monthly or annual base. In your case, you're not going to do this, okay? And the strategy to meet your goals. So your strategy will be related to the risk tolerance that you're going to define later on. And this strategy, of course, will define the asset allocations. So if you have a portfolio with more conservative asset class, like bonds or fixed income or treasury bills, so you need to increase the allocation of these assets. If your portfolio is more aggressive for more risk tolerant investors, so we are going to increase the asset allocation of equities, stocks. So let's talk about the portfolio objectives and asset allocations that you will develop for your portfolio. First of all, we need to understand, as explained in class, that the broad asset classes, they have a different relationship between return and risk. Okay? So if you want asset class with a lower level of risk, will be with a lower standard deviation, we go with money market instruments, which means treasury bills. In your case, you're going to work, you can select for your portfolio treasury bills. If you want fixed income with a little bit more of a risk, you can select investment grade corporate bonds, which mean corporate bonds with a higher level of return and a lower level of risk. And after we move to different types of equities, stocks. So large capitalization stocks that provide higher risk and higher return, even more risk and return with mid capitalization stocks, and finally small capitalization stocks that provide a higher level of return for a higher level of risk. So we're going to see how these assets could be used in a portfolio. We see that if we combine the size of portfolio from large to small capitalization, large capitalization provide a lower level of risk. Small capitalization, a higher level of risk. And we can also combine two different classes of assets. Value assets, more conservative companies from consumers that pay dividends, with growth companies more related to technology, companies which are in the growth cycle of business development. Right? So in the traditional portfolio objectives, we are going to define the strategies that you are going to select for a portfolio in function of the risk tolerance that we are going to identify in class. Okay, so a portfolio with a lower risk is a portfolio with a stability of a principal. Stability of principal means that I want to preserve the totality of my capital, the totality of my initial equity. So this first portfolio is a risk-free portfolio. You are not going to work in this exercise of a risk-free, but you need to know that there is this possibility of using money market instruments. So the three types of portfolio we're going to develop, they go from conservative to moderate or aggressive exposure to risk. Okay, so I'm going to jump to this one. So a conservative stock or conservative portfolio of stocks is a portfolio using a class of stocks called value or income stocks. Which are value income stocks? Are stocks which are usually undervalued in price and pay dividends. Okay, so they generate income, dividends. So these stocks, they generate dividends rather than capital gains, which are growth stocks. Some of them, they can also generate value, income, and capital gain. We call this class of assets as blend stocks. Okay, so these stocks have a relatively low risk, and the category of securities we can use in a conservative portfolio. We are going to focus on large capitalization stocks, like a broad asset class, and you can move to value stocks, which will be a breakdown of this large capitalization stocks. So we focus on large capitalization stocks. From this, I can select stocks from specific sectors that are more conservative: consumer staple stocks, utilities, industrial, real estate sectors. So these sectors, they pay dividends. So that's the reason why we call them a value income stocks. And we can associate with fixed income assets, like bonds, government or corporate bonds, and treasury bills, which pay a small interest, and they are considered to be money market instruments. Okay, so the target investor for this type of portfolio are investors with a retirement goal, with an age above 55 years old. Okay. So the second type of portfolio is the category of moderate portfolio, which means the investors that have a moderate tolerance to risk. A moderate tolerance to risk means that I can add to my value stocks growth stocks. Now, which are growth stocks? Stocks which from companies which are in a growth phase in a business cycle. So these stocks, they provide a higher level of capital gains. Okay. And in growth stocks, we define stocks from technology, healthcare, telecommunications, and consumer discretionary sectors. And also stocks with small and mid-size capitalization. Okay. So here in this portfolio, I am mixing growth with value. So value, I can use the stocks I have this described in the past portfolio. So we can combine growth assets with value assets. We can combine technology with consumer staples if I want to create a large segmentation of my portfolio. Okay, and associated this to the bonds. Which type of bonds? Usually in a moderate portfolio, we focus more on government and corporate bonds and less on treasury bills. Okay, the target investor for this portfolio are investors, middle-aged investors from 35 to 55 years old. And finally, the last category of portfolio is addressed to high tolerant stock investors, in terms of risk. So we call this aggressive portfolio. So what you expect is a quick capital appreciation of my equity, a quick growth of my equity. So to obtain a large growth in my equity, I needed to be exposed to higher risk. So higher return, higher risk, as we have learned in class. So this portfolio has a high exposure in equities. Usually investors, they use more than 8%, 75 to 80% on equities, giving a preference for growth assets. So growth stocks coming from technology, healthcare, telecommunication, consumer discretionary sectors, small and mid capitalization stocks, as we saw before. And we can associate as well a small part of blend assets, growth, so large capitalization stocks, and with sectors a little bit more conservators. The target investor for this type of portfolio are young people. So young people which could accept a higher level of risk. So now let's see how we are going to organize the portfolios or your portfolios following the type of asset allocations, asset class allocations, and risk acceptance objective. Okay, so that's a general or broad asset allocation used by the majority of mutual funds. So a conservative portfolio should have from 70 to 75% of fixed income securities. Fixed income securities means corporate bonds and long-term government bonds. 15 to 20% of equities, mostly equities, stocks or large capitalization stocks that pay dividends from more conservative sectors, as we saw before, and 5 to 15% of cash equivalents. Cash equivalents could be the treasury bills. We're going to see which treasury bills you could be using in your portfolio. So when you move to a more aggressive portfolio with a moderate level of risk acceptance, we start decreasing the allocation on fixed income securities, bonds, and increase the allocation of equities and moving to equities with a little bit more of growth. So equities from small or mid-size equity stocks, or stocks with a growth profile. And finally, a very aggressive portfolio, so a portfolio to invest with a large tolerance to risk. We can go from 80 until even 100% of equities. Okay, 10% of fixed income and 10% of cash. There are other more specific allocations. So when we go from broad allocations are the major categories. No, fixed income, for example, fixed income bonds and stocks are the broad allocation assets. So I can break down this in allocations with different size of stocks, large, mid capitalization, small capitalization. I can even use international stocks, which means stocks outside of the United States, Europe, Asia, and emerging stocks. Emerging stocks which have a little bit higher level of risk, but you can expect a higher level of return. Okay? So here we have the different breakdown allocation of equities and bonds following the different level of risk tolerance: conservative portfolio, moderate portfolio, and aggressive portfolio. So you can use this as a model to create your portfolio. Okay, all these examples are here to help you to create your own portfolio. So we don't need to go with this breakdown allocation. Okay, you can decide to use the index. We're going to see ETFs that cover the large or broad allocations on equities and fixed income. And in the following slides, provide some ideas come from the big mutual fund investment firms. These ones come from Charles Schwab. So we're going to see that how the large mutual fund institutions, they define the conservative, moderate, and aggressive portfolios. You're going to see they follow more or less the same percentage distribution between equities and bonds. So you can see an aggressive portfolio has 95% of equities and 5% of bonds or cash. This one has 6% of stocks and 40% of bonds, and a conservative, you get 20% of stocks and 8% of low risk assets, bond, and portfolio. There is another one here as well from Fidelity. Okay, so you can inspire from these ideas to create a portfolio. Finally, from Vanguard. So Vanguard shows some examples. So you can use this. So the idea is these examples are to help you to define and choose your portfolio. So you can choose one of them or a mix of them to define how you be your portfolio. Of course, following the risk, the risk tolerance that will be defined before you are creating your portfolio. Now, let's see which asset class you should be using in your portfolio. So these portfolios will be exclusively created based on exchange trade funds. So what are exchange trade funds? Exchange trade funds are mini mutual funds that are created based on the different type of asset class: stocks, corporate government bonds, treasury bills, commodities, currencies, and derivatives. So at the end of the day, what you're going to do is to create portfolios using ETFs, using a diversified portfolio of a large capitalization or international equity, or a blend of bonds in portfolios. So the ETFs, they can be represented by countries, by regions, or by the broad index like the S&P, the DAX 30, which is the index from Germany. You have an ETF for the Chinese broad market, for Brazil, India, Europe, Asia, emerging markets. We have ETFs for different types of market capitalization. So you don't need to go and select stocks, large capitalization stock. There is already a portfolio of large capitalization stocks inside of an ETF, which is a mini mutual fund. Okay, you have for mid capitalization, small capitalization, by different sectors in the economy. Okay, and finally by the different types of government bonds and even for commodities. So this is what is going to facilitate your task any moment you're going to create your portfolio. Okay, saving a lot of time by satisfying the conditions, okay, the conditions you have defined for your portfolio in terms of equities, bonds, or in terms of the uh, um, uh, breakdown allocations in different classes of assets. Okay. So here, the information you can get from ETF DB, if you want. The ETF DB is the ETF database, or I add some links, okay, where you can find a list of ETFs following different classes of assets. This one is for different market capitalization, large, small, and mid, growth in value ETFs, bond ETFs, and sector ETFs. Okay, if you want to create your portfolio, okay, following this idea, the idea of breaking down your categories. Okay, so an ETF. Here you can see some examples where to find information to understand better the ETF you're going to use in your portfolio. Okay. And finally, let's see some examples of ETFs that you can use for your portfolio. So these ETFs I suggest you, because these ETFs, they have a higher liquidity. They are largely used by mutual funds and investors. Okay, so if you are going to, if you know portfolio, you have a large capitalization stocks. Okay, so you can look for the broader index like S&P, so SPY, or VTI, which is 1,500 S&P, or we can use, if you want to break down this more in growth or value stocks, we have an ETF that takes from the S&P VTI all stocks that represent growth stocks, stocks with a higher risk, high return, or stocks which pay more dividends in value. So again, we are going to link this, okay, to the objectives of your portfolio. Okay, so these objectives respect what was described here. Okay? So you need always to, this becomes, okay, the guideline of a portfolio. If your portfolio is a conservative portfolio, this should be your guideline. You need to look which type of objectives I have, okay, and which type of assets I'm going to use. These assets now, I can identify them, okay, now crossing over with the information I get here. Okay? So I have here a list of large capitalization stocks. I have a list of mid capitalization stocks. So MDY is one of the largest, the most important ETFs for this. Small capitalization stocks, we have two options. Both ETFs, they are largely used as well. If you want real estate, for example, for a specific sector, so many investors, they break down the equities using a part of a real estate. So real estates, they are sometimes disconnected or have a lower correlation to the market, so I can use VNQ and ICF in my portfolio. Or if you want more detail in your portfolio, you can use US sectors. So you say, look, in equity, my portfolio has my portfolio is an aggressive portfolio. Okay, let's see again, an aggressive portfolio. It's a portfolio which has more than 8%, okay, more than 8% of equities. So I know that I could be using technology, telecommunications, so I can get these sectors ETFs, or I can use a blend of large cap and blend sectors. So if I want to use an 8%, 15% of technology, 10% of telecommunications, 5% of consumer discretionary, and mix with 5 to 10% of this, it's okay. Okay? So where I'm going to get these ETFs here? I'm going to get from sectors. So I have a list of them to put in my portfolio. If you want to be a more global portfolio, you go with the same ETF by sector, but now we are covering companies outside of United States, plus companies in the United States. So you can decide which one you want to use in your portfolio. Okay. For international stocks, which ETFs I can get? We have here ETFs from developed countries. So all developed countries outside of United States. So you're talking about Canada, European countries, Japan, Australia, and New Zealand. Or you can decide, look, international stocks, I would like to use Europe because I believe Europe will be a good investment. The companies are going to grow in Europe. Or you can use a more general ETF that covers all countries around the world, is ACWI. Okay. For emerging countries, that's the ETF, EEM. Fixed income securities. Fixed income securities, we have two different classes of fixed income. One are the corporate bonds. So I have two options for corporate bonds, AGG or BND. And for government bonds, you have government bonds with different long terms, 7-year bonds EAF or 20-year bonds TOT. You can select one of them. Or in a portfolio with a higher risk, you can use high yield bonds, GNK. Okay. So for lower risk fixed income assets, the money market assets, the treasury bill, we are going to use, you can use a TIP, which is a short-term inflation protection. You can use the bill, which is a treasury bill ETF with less than 1 year, or shy with 1 or 3 years. Okay. And finally, if anyone wants to have some exposure on gold, use 5 to 10%. You can use an ETF on gold, the GLD, or use an ETF on total commodities or only agricultural commodities. Okay. I recommend for you at the end. Okay, let's just put it here before I go into the. I recommend for you, do not use a large number of ETFs. Otherwise, this is going to complicate a lot your task required for your report. Okay, so let me do so. So if you are going to use, you're going to select the ETFs for your portfolio. So a simple portfolio. So a simple portfolio, for example, a conservative portfolio, you can take VTI or S&P, okay, plus two ETFs, fixed income ETFs. Okay, this one for equities, one for equities. So one of them, this or equities, and this for fixed income. Okay, for example, I'll give you an example. That's the simple version of a portfolio. This type of portfolio is what was explained here at the beginning. Okay, and if I'm going to add a little bit of fixed income, I can pick here. Okay, this is a portfolio I can get. I can put 20% of one of this, and in this case I can use 40% of each. Okay, that's the simple portfolio that respect my conservative objective. Right, that's respect. I can do the same for the other portfolios. Okay, so that's a simple version of a portfolio. But sometimes, okay, we cannot obtain the best result of this. So what if I want now to get this portfolio a little bit more, I want to do a breakdown of the portfolio instead of of S&P or VTI, okay, I can get a portfolio with, take one example here. So I want a portfolio with value stocks. Okay, I want to take value stocks. So I can do the same. Okay, the other option, I take value stocks, 20%. Okay, and do the same for my fixed income. Okay. What percentage? Correct. So here, what I'm doing is this is my conservative, okay, conservative portfolio. Correct. If I want to break down this, so I can go with a specific sector. Look, I believe that utilities and consumer staples, okay, they are considered to be conservative. So how do I know about this? So I go back to my conservative stock, what I say, utilities and consumer staples, correct? Utilities and consumer staples. So I go to my portfolio and look which ETFs represent consumer staples. Utilities XLU, consumer staples XLP. So the other option in my portfolio is doing this. No, is sorry. I can take XLP 10% plus XLU 10% and keep the same. Okay. So these are XLP 10% and sorry plus XLU 10%. Okay. So here we have the same conservative portfolio done in three different ways. I can take the broad large capitalization, represent equities. I can take only the value stocks, or I can take the value stocks by sector, which are inside of this. Okay. In any case, I am respecting the conservative tolerance for risk. Correct? So that is the same you can do for all the other portfolios. The moderate portfolio. So use this as your guideline and go to the ETFs to see which one, okay, represent what you want, what you need to respect the objective in terms of risk tolerance for your portfolio. Okay, so in this case we have 1, 2, 3 ETFs, 1, 2, 3 ETFs, 4 ETFs. So the thing is, when you go with the portfolio with the higher risk, okay, portfolio with the higher risk, we start using more ETFs. Okay, so I recommend to you, do not have in a portfolio more than 6 or 7 ETFs. Okay, otherwise it's going to complicate a lot. Okay, trying to make in a portfolio the maximum of 6 to 7 ETFs, okay, in your portfolio. No more than this, because the calculation I'm going to do is going to become very complicated. Okay, it's easier to manage as well in the real terms a portfolio with a limited number of assets as well. Okay. Now, finally, to finish our presentation, so this is when you have defined your portfolio. Okay, you are going now to create your final report. So this is what you're going to send at the end of your case study. So you find a portfolio, so give your name a portfolio. All portfolio has a name, like investment fund. Search for a fancy name or a name that represents the risk tolerance of a portfolio. And we are going to start defining the first objectives and financial goals of a portfolio. Remember, this comes from, okay, in a portfolio, we start by setting the portfolio objectives. Okay, so my portfolio objectives, after selecting the ETFs, okay, for a portfolio, and after doing the calculations, so we're going to see which calculations we're going to do in the last part of the portfolio. We are going to put here the result of your calculation. So this portfolio, which is a conservative portfolio, for example, must preserve the maximum, the capital of my equity. Okay, so you can use the information I have here to define the objectives of each one of your portfolios. Aggressive, moderate, okay, you have a definition here. So you're going to get information here to do not spend much time. And you can go and visit the internet as well. Okay, use information from the internet, because this is the general information for the objective of portfolio. Define the time horizon, so all portfolios are going to have a time horizon of 5 years, so mention the time horizon of portfolio and the initial equity of portfolio. So all portfolios are going to start as well with $100,000 or euros for portfolio. So once you did this, we are going to define now the portfolio strategy. So we are going to describe the risk tolerance of portfolio. Okay. And you are going to define the strategic allocation of portfolio following the instructions I have gave to you. So which are your broad allocations, and after, if you decide to go with specific or breakdown allocation, so you're going to describe this in percentile terms as well. Okay, so a portfolio has 20% of equities and 40% of bonds. The 20% of equities are represented by S&P, or the 20% of equity are represented by the value ETF, or they are represented by 10% of consumer staples and 10% of utilities, plus 40% plus 8% of bonds. Okay, and bonds and the 8%, I have 40% of BND or TLT, okay, or other bonds that I suggest in these slides. Okay, so this information you can get from the slides 15 to 18. So the slides are here. We're going to use this information to put in your report, and after, okay, breakdown, if you decide to use breakdown from these slides, from slides 22 to slides 26, correct? What I mentioned here. So remember, use only ETFs and not stocks. Okay. So use as much as possible. Let's go back here. Use as much as possible pie charts. Okay. Pie charts means when you have select your ETFs. Okay. You describe what's the percentile, the broad percentile, equity and bond, equity and fixed income, and after, if you have breakdown allocations by size, by type of stocks, international, emerging markets, or by sectors, you need as well to describe this, okay, in your report. So the idea of a report is giving the maximum of transparency for the investor. So you need to know which are the broad assets and the specific if you are using or recommending for your portfolio. Okay? Remember, this is your choice. Nobody's going to impose to you. And when you have defined your portfolio, now with the allocations of your portfolio, you're going to calculate the portfolio statistics. So I recommend you being in a group of 3 or 4 students is to split this task. Okay, so to give to each one of the group members one of the statistical calculations. Okay, so the first thing we're going to calculate, as we saw in class, so the portfolios, they have to have an idea of expected return risk. So you're going to use 5 years of historical data. You're going to see later on where to find this information to calculate expected returns. So we are going to calculate the geometric average. Okay, for a portfolio, what's important is the compounding interest. How much my portfolio is going to grow year after year using interest or over interest, the same way we learn in class. Okay? After that, with the expected returns calculate, I'm going to calculate the standard deviation of these returns. You can use Excel, okay? All these you can use Excel, geometric average. So you prepare your Excel spreadsheet. This is very easy to do. And finally, I want to know what is the risk premium of my portfolio, how much expected return minus the risk-free is given in terms of return for every point of risk, every percentile point of risk, and this is a Sharpe ratio. So use 2% as average risk-free for this 5 years period, okay? And to calculate the Sharpe ratio of a portfolio. So now I have expected return, the annual compounding rate from 2015 to 2019. So I'm going to use the entire years, the whole years. So I have 2015, 16, 17, 18, and 19. I have 5 different returns. The standard deviation of these 5 years, the Sharpe ratio, and I'm going to calculate the beta, the portfolio beta. So the portfolio beta, I recommend you to simplify the task. You don't need to calculate a linear regression as you see in class. Go to FinVis, and in FinVis you can get the betas of all ETFs. The bond ETFs, they don't have a beta, so we're going to consider beta of bonds equals 0. Okay, and you're going to calculate the beta for portfolio. So if your portfolio has 20% of equities and 8% of bonds, well, I'm going to take the 20% of S&P, which the beta is equal 1. So your portfolio is going to get a beta equal 0.2. 20% of SPY and 8% of 0 beta give to me a beta for portfolio equal 0.2. So this, go back here. So if your portfolio has different ETFs, okay, you need to take the beta for each ETFs and do the same way we did in class to calculate the weighted average beta of a portfolio. How much you have allocated in each different class and in each different asset. Okay, for example, if my portfolio is a moderate one, I have 20% in large capitalization stocks. I'm using for large capitalization stocks the S&P. I'm MDY. I'm use IWM. So I take the beta of each one and I'm going to use the weights of each one. Okay. Remember that bonds have a beta equals 0. With this, I can get the total beta. Correct? You have to show all calculations. So in your final report, you're going to show the numbers, only the numbers, but you need to send to me, okay, from where you got your calculation. Send me your Excel spreadsheets, okay, with all calculations of expected return, risk, Sharpe ratio, your portfolio beta. Anyway, I can check that your calculations are correct. I can grade you based on your calculations, okay? And finally, we are going to create an equity curve. The equity curve means what? How much your portfolio increases in value year after year. With the geometric average, you're going to show in the portfolio. Showing you an example here. Portfolio start at 100,000, okay, and year 0. Year 1, take this out. That's year 0, okay, that's my initial value. Initial equity. Year 0, okay. So if your portfolio has a compound, let's say your geometric average is 5%, for example. So in year 1, at the end of year 1, you're going to multiply by 1.05, and this you're going to get your equity $105,000. Okay, so a year 2, because your average return is always 5%, you're going to multiply by 105,000 times 1.05. Okay, so we get here, just a second. This in the end of year 2 you'll be 110,250. Okay, so you do this for all years. Okay, you do this year after year. Year 3, year 4, year 5. So your equity curve will be 0 at the beginning, and it started going to 105, 110. So you're going to create a chart of this, okay? And this will become your equity curve until year 5. So you're going to see how much your portfolio expects to get at the end of year 5 will be this. We are going to compound year after year by 5%. Okay, so this will be your final equity curve. And as we see in class, so revise these slides in class, let's see which year the portfolio, what was the drawdown the portfolio. So when the portfolio reached, the equity reached a peak, and when the equity reached a trough, a down, and is 5 years. And this will be your drawdown. It will be the risk of your portfolio. So you can do this visually once you have calculated your equity curve. Okay. So all this information you're going to get from Yahoo Finance. So all the information go to create from Yahoo Finance. So which means that you go to the page of Yahoo Finance. You're going to enter the symbol ticker. You can see on the right there is a box. The symbol ticker. You're going to get this, for example, S&P. You have historical data. You're going to click on historical data. You're going to get this page, and here you're going to define from December 31st, 2014, because I want to get the first day of 2015 until December 3rd of December 2000, the last day of 2019. Okay, use monthly data, facilitate it, apply. You get all data here on the left. Okay, and you're going to download the data. When you download the data, you're going to get this spreadsheet, Excel spreadsheet. So you have the monthly date, 1st of January 2015. So you're going to get the first date, the first day of the year to calculate the annual return. So the annual return from the year of 2015 will be this value minus this value, no? Divide by, you're going to calculate the holding period return. We are going to use the adjust close information. Why? Because here we have already okay, the dividends paid by the ETFs. Okay, so here I get the dividends paid by the ETFs. They are already discounted on the price. So you see, you take for this for 2015. For 2016, I'm going to take the first day of 2017 and the first day of the. So I take this minus this and divide it by this. Okay, the holding period return. Correct? We are going to do this for your portfolio, and I'm going to do all this. I have this as well for your benchmark. So your benchmark is the S&P. So you do the same for the S&P. Calculate expected return. We're going to calculate the expected return, the risk Sharpe ratio, beta is equal 1. Okay, and you do the equity curve for the S&P. Like this, you can compare the performance of a portfolio with the performance of the S&P. Okay, so we are going to find something. Let me see one curve here. Let me see. If you have a curve of you're going to get something like this. Okay, see, this is not a good example. Okay, you're going to get a curve of portfolio, a curve of the S&P. Okay, so this is going to give an idea if your portfolio is outperforming the S&P or not. Okay, so if you have any doubt about equity curves, go to the internet. There's a lot of information on this. But simply put, the curves are not difficult to calculate. If you follow what I showed to you, you could get the information, create a chart of this. Okay, you're going to do the same for the S&P. As the S&P started with 100,000, if you had to invest the entire capital of S&P, how much you're going to get year after year. So you need to calculate as well the geometric average return of S&P, standard deviation, and put all this in a table where you can compare both results, and you see if your portfolio is going to obtain a better Sharpe ratio than the S&P. Correct? So that's all for your portfolio. So we are going to comment in class, but this video will be available for you if you have any doubts to consult it again to develop your portfolio case study. Thank you.